Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, top US banks withstand annual ritual of Federal Reserve stress tests, as well as that the Japanese yen falls to weakest level since 1986. We've got lots to talk about on the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around soon to see that. Before we get straight into it though, make sure you subscribe. But the first article to talk about is of course to do with these top US banks. Now, the top 31 largest banks of the United States have now passed the yearly so-called Fed's stress tests in a move which proves to regulators that they could withstand a recession. This stress test presents to banks a theoretical scenario in which unemployment rises to 10% during a severe recession, in which banks like JP Morgan, Goldman and Bank of America would all nearly lose $685 billion and suffer their biggest hit to capital in 6 years. Now, to be honest, we don't usually talk about these stress tests and that kind of thing. Well, why that is? Well, it's because there's only one every 1 year or so, as we mentioned in the kind of introduction. Nonetheless, this is a very important topic to always cover. We're always covering the kind of topic of, potential economic recessions, or, the actual topic of economic recessions, or even, levels of inflation, what the Fed's saying. All of that, context is important to apply to markets, especially when we're kind of looking through that macroeconomic lens. And that's kind of what this adds to, this also adds to that kind of context that we always need. As what this stress test kind of finds out for us is, how solvent, how protected are these US banks when it comes to the issue of recession. So it helps us kind of contextualize, when we're reading about, potential recessions here, there, or, anywhere else, whether that will affect US banks enough to make them, have to go bankrupt, and whether then we'll see a kind of similar fallout that we saw, of course, with the 2008 financial crisis, which is why, this topic is so important to, of course, cover. In terms of what this stress test, though, has discovered, the question is of whether, that will actually affect markets much. That, of course, the stress test did discover the fact that basically all of these banks could withstand such a extreme recession, which is, of course, very positive news. So one could, begin to interpret this as kind of a more bullish piece of news for markets. Obviously, if we heard, the more negative results from the stress test, if we heard that many banks would fail this stress test and as a result would fail during an extreme financial crisis, then of course I think markets could definitely respond in a bearish manner to such news. But this is something that, as we'll get into as we go through the article, this is a result that was expected by economists, by investors and that kind of thing, because previous to this stress test, all top US banks have passed these stress tests over the past few years, with that even leading many economists and many other officials to start questioning the relevance of these stress tests. So that's kind of an important thing to clarify, especially when we're talking about the impact that such news might have on the markets. Well, ultimately, if this is something that is widely expected by markets, like we see with economists' forecasts, and then that piece of data coming out matching that forecast, we often don't see a large move in the market when we get that piece of data because it matches the forecast. And in this case, it does seem like that was something that economists and officials were expecting, that this would pass, these stress tests would pass. And so the kind of effect on markets, I doubt, would be as great. I still think, though, it's so important to kind of know and cover, just simply because, as I said at the start, it provides that context that we always need. If these stress tests did kind of show a more negative image, showed that some banks would fail, this would have a dramatic impact on the market, I believe. And ultimately, the fact that these banks have once again passed does kind of allow us to understand, when we're seeing these maybe less positive GDP growth rates from not necessarily from the US, we've seen that more so in Europe recently, but should we start to see certain figures coming out from the US presenting, not strong growth in the US economy, ultimately it kind of allows us to not worry as much, especially when we're looking at US equities and that kind of thing, especially looking at the financial sector, because ultimately we understand that these US financial institutions have passed their stress test. So it is still very important to kind of stay up to date with, especially because it's only once a year. And so just having a look at it once a year allows you to kind of have that safety, or at least allows you to have that kind of peace of mind when it does come to this topic. So a very interesting article nonetheless, with this test ultimately concluding that such banks would still meet the regulatory minimum standards. The test also involved a 40% decline in all commercial real estate prices, with a substantial rise in office vacancies and even a 36% fall in house prices. This annual exercise began following the 2008 financial crisis and has ultimately become a key factor in rebuilding the confidence of the public in the banking sector, That said, due to the banks passing with great margins in recent years, some have questioned the test's relevance. This test also came at a very interesting time for large US banks who have currently faced an increase who are currently facing a renewed focus on capital levels, with regulators looking to enable endgame capital rules. Following the rumours of such a proposal, the largest banks in the US began an aggressive lobbying effort, which saw Jerome Powell pivot his position on the proposal, with this meaning that material changes will likely be made to that proposal, which initially proposed for changes to the kind of minimum amount that of capital that banks need to hold, as these tests are ultimately used to calculate the minimum amount of capital that banks need to hold against their assets, with this year's one pushing down the capital ratio 2.8%. So a very interesting article there on this topic, of course, and one which might bring some kind of comfort to certain investors, especially that are invested within the US equities market and that kind of thing. But still, I think it's an important one to cover. That's all to talk about on this article, though. Next article to talk about is to do with the Japanese yen, which is, of course, something that we most usually covering on the charts, that period of the morning market briefing. And of course, we will be covering that once again today with pound yen. But I think this article is very important to kind of cover, as this allows us to better understand, the fundamentals, the real, kind of economic context to what's going on with the yen, as this article does kind of note. With the Japanese yen now falling to its weakest level against the US dollar since 1986. This comes in a new move which alerts traders of the new risk that officials might be once again forced to step in to support the devaluing currency of the yen. Now, if you're a frequent kind of viewer of this channel, or you kind of look at the yen a lot on the charts, as we do with TradingView, ultimately I'm sure you're very much aware of the kind of poor state that the Japanese yen is in, as we've seen this kind of constant decline for the yen against other currencies, with pound yen, of course, breaching above the 200 yens for a pound mark recently, and of course that kind of represents that weakness for the yen, and that kind of constant push to the upside in the yen is something that we've really been seeing for multiple years now. I'm trying to kind of pinpoint that, but at least for the past 2 years we've seen this kind of bullish rise, especially coming out of the lockdown period, coming out of COVID. We've definitely seen this kind of push to the upside with pound yen, and it really doesn't seem like it's going to turn around anytime soon. And this is, of course, kind of a worrying image for not only the Bank of Japan, but also the Japanese government and individuals in Japan, as many have noted that this kind of weakening of the yen has in fact kind of worsened living conditions within Japan for the everyday person, as ultimately it's kind of made the cost of living more expensive, and as a result of that you're making it harder to kind of go about your life, and this is of course something that the government wants to solve, or has to solve, and that's why we're now looking at this kind of potential currency intervention like we've seen previously, as this is something if you've been looking at the charts over the past few months, as we do on this channel, you'll have noticed the kind of volatility that we've seen with pound yen and other yen related pairs, because ultimately we've seen these kind of massive drops and massive spikes because of the kind of intervention that we've seen from the government and the Bank of Japan. And should we see that again, it's likely that we kind of see such price action play out once again on pound yen or US yen and that kind of thing. Ultimately, though, we will have to wait and see, as we'll get into as we cover this article. Ultimately, certain officials, certain key analysts have already pointed out the certain levels which, should the yen reach, should the yen decline to, we could definitely then see intervention from the government or the Bank of Japan, with the yen once again slipping 0.6% over the course of yesterday against the dollar. This now means that the yen against the dollar is below the level it reached back in April, just before the Japanese Financial Ministry spent $62 billion to boost the currency. In response to the continued decline of the yen, Japan's top currency official has told reporters that the government was seriously concerned about the yen's decline. Added to that, he went on to say that he would respond to any excessive moves. Key individuals in the currency world have also told the FT that should the yen fall back to the 162 yens for a dollar mark, intervention would be justifiable. The government wants to stop the yen falling since it's pushing up living costs. So that's the kind of key news to note for the yen, it does seem like, at the moment, and just for the kind of financial world as well, as we covered with US banks. That's all to go out on the articles, though. Next to talk about, like always, is the charts, where quite a bit is happening, lots is playing out, and lots is to note as we do kind of start to come to the end of the week. Like always, though, we are beginning on the US 30 with the Dow Jones, which is making some interesting moves after reacting to that key Fibonacci retracement level of 50% that we did note in yesterday's morning market briefing, or maybe the day before. But now, over the course of yesterday's market action, basically we've seen price now interact with that 50%, with price obviously retracing over the course of the start of this week, and then yesterday interacting with that 50%. We noted that level out, of course, because it does line up with that key liquidity zone which price has previously interacted with, and so it will be interesting to see now whether price will swing to the upside after finding possibly that bullish liquidity that it needed, in which case we could definitely see, like I've said before, price swinging up to that kind of minus 27.2% Fibonacci extension level. As always, though, I think it's important to note the kind of context, the kind of on the bigger picture, the context of the US 30 when we're looking at the charts. Now, this Fibonacci retracement tool has, of course, been mapped out onto the price action that we've seen since the 14th of June. And, of course, the date of recording is the 27th of June. And why that's important to note, well, this is kind of shorter term price action that we're seeing. So we are noting the potential for price to swing to the upside. But at the same time, if we look on the larger time frame, if we look at the price action, all the way since the 20th of May, and we draw out the kind of Fibonacci retracement tool from there, we of course can find that 78.60, which lined up with that price action which we did see on the US 30, which saw price move up into that key liquidity zone, interact with that 78.60, and then sell off from that level. And so we're kind of facing these two conflicting positions or ideas, bullish and bearish, for the US 30, in which whether price will now sell off and continue this move to the downside, because ultimately prices interact with that larger time frame 78.60 level, or in fact, because prices now react to that 50% Fibonacci retracement level, price may now swing to the upside and continue this move higher. So that's the kind of question that you've got to ask and then answer. That's all to talk about on the Dow Jones, though. Next to talk about, like always, is the dollar, which is continuing this push to the upside after, of course, starting off the week reacting to that 61.80 and key liquidity zone. And as a result of that, we are now seeing price interact with that Fibonacci extension level, which of course I've been noting for quite some time now. We have however, not yet interacted with that minus 27.2% Fibonacci extension level, which is the kind of level marked out from the previous price action made about around the 14th of June. So it will be interesting to see whether price can make its way all the way up to that level, which is very much near that kind of higher level of liquidity and resistance that we've previously noted out, which is near and around the 106.4 level, and the Fibonacci extension level is more so near the 106.24 level. So definitely keep your eyes on the dollar. Very interesting price action there. I think it's I just kind of want to draw out this trend line here to kind of maybe map out the price action that we are seeing. So if we were kind of forming this bullish flag or bearish flag, we could definitely say that price, if price was kind of still within this territory, you could definitely say that it's a valid kind of a position to believe, and that's the kind of price action which could take place. But ultimately, price is currently kind of pushing out of that area, so it's questionable the relevance. But I'm still going to keep up that kind of key trend line that's marking that recent price action. So definitely keep your eyes on the dollar. Next to talk about is Euro USD, which has interestingly made this double or triple bottom now. Pardon me, I'm not with it today, but ultimately we have now formed this kind of triple bottom, which is very interesting to see, of course, and it will be interesting to see now whether we swing to the upside once again, like we saw back on the 14th of June and the 23rd of June. So it will be interesting to see whether we now see that price action play out once again, with price possibly swinging back to the upside and interacting with that Fibonacci retracement level of 38.20 once again. But should we see price break to the downside, like always, that minus 27.2% Fibonacci extension level is the kind of key target, which does line up with that key liquidity zone, which forms the very bottom of the market. So very interesting moves being made currently on Euro USD. Very clean price action, so definitely keep your eyes on it. Next, talk about those pound yen, which we of course have kind of already covered with the articles, but ultimately the same is to be said for pound yen, like we said yesterday, which is price is continuing the slow push to the upside, somewhat slowing down and consolidating, but ultimately is still pushing slowly higher. And it over the course of yesterday did kind of breach the 203 mark, and made its way all the way up to the 203.1 mark. So very interesting price action there being made by pound yen. It'll be interesting to see now whether price does continue that push higher, or in fact does the speculation to do with the possible intervention by either the Japanese government or Bank of Japan does lead traders to push price to the downside now, but we'll have to wait and see. Next talk about though is Bitcoin, which has of course retraced from that massive decline that we did see over the course of Monday, but ultimately has only retraced that 50% Fibonacci retracement, that 50% level on the Fibonacci retracement tool, which lined up with that kind of $62,500 a Bitcoin mark, which of course is also a very key psychological level. And from that level, over the course of yesterday, we've seen price fall to the downside, and the question will be now whether we continue to see this kind of decline for Bitcoin, as we just wait to see whether the Fed will change its monetary policy outlook, and only then maybe we'll see Bitcoin's rise once again. One thing to note though is should price kind of stay within this larger range that we've seen form, this kind of period of consolidation which is formed on the larger time frames, then definitely the kind of overall picture does still seem bullish somewhat, and so I think it's still important to kind of zoom out sometimes and have a look at where Bitcoin is actually sitting. Next to talk about though is gold, which has kind of continued this sell-off that we noted on the 1 hour, as I did note that kind of Fibonacci retracement tool on that kind of retracement that we were seeing take place for gold after price did sell off to the downside, interact with this kind of key liquidity zone, and then move back to the upside. And now seemingly price has reacted to that 38.20 in key liquidity zone, and now we're in the process of selling off once again, with price breaching below that minus 27.2% Fibonacci extension level, and now price is very much near, if not has interacted with this lower level of liquidity that's formed the bottom of the market since the 9th of June. So definitely keep your eyes on gold. Very interesting price action being made at the moment. Lastly to talk about though is oil, which once again remains within this kind of period of consolidation, this range that's formed. It's very interesting to kind of see and watch, and obviously news from the Middle East and other areas, other conflict areas, is heavily impacting the movement of gold, of oil at the moment. So definitely keep your eyes on that. That's all to talk about on the charts though. Lastly to talk about though is the economic calendar. We are getting quite a bit of data. One thing I do have to preface though is ultimately in yesterday's morning market briefing I did use the wrong economic calendar. I used the economic calendar for today, not yesterday's one, and as a result we are going over the same economic data that I covered in yesterday's morning market briefing. Now firstly we are receiving the Japanese retail sales figure, followed by the Chinese industrial profits figure, as well as the Italian business and consumer confidence figure, and followed by that we're receiving the Eurozone's consumer confidence figure and Eurozone's economic and industrial sentiment figure, followed by that receiving the Spanish business confidence figure, and to end off the day we're receiving the US durable goods orders figure as well as the US GDP growth rate figure. And those are the two key figures that we are receiving today, and those will have the most impact on the market, I do believe. That's all to talk about on the economic calendar though. We've got lots in the on the articles, lots on the charts, and lots on the economic calendar. Here we have a great trading day, but that's all from us at Wildwood Capital. Sorry for being so slow today. See you later. Bye.